Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. I'm Sakar Cowley, and with me I have the pleasure of having Anthony Walker with Buckingham Brokerage. Welcome to the show, Anthony. I appreciate your time.
Thank you. We're happy to be here.
Awesome. And Anthony is based in Los Angeles, which we all know is a very high-priced market. And today at the show, we are going to get into some interesting aspects of how his company has been able to acquire properties in such a low cap and a high price environment and make it work. So I think it's going to be a very insightful conversations today, where Anthony is going to share some of his tips and tricks as to how he identifies and what goes behind sort of acquiring such properties and the intelligence that you have to build around it. So with that, Anthony, welcome to the show one more time, and please give me sort of your background, how you started investing, how you came about, and what sort of opportunities you're looking at this point, Anthony.
Yeah, absolutely. So I got into investing first because I met the company that I work with now as a broker called Buckingham Investments. I was a client of theirs. And they specialize in just teaching investors to get started, mostly with multifamily investments right here in our local area, which is Southern California, which I know a lot of people think you can't make money here. I bought my very first investment property in 2006. Obviously not the greatest timing there. And I wrote that one all the way down and all the way back.
But we all know what happened just 2 years after, right?
Yep. Didn't give it back though. And then I really started to get aggressive on the multifamily side. Around 2010, 2011, picking up stuff there. That's when my relationship with Buckingham started. Started with a little duplex in Long Beach, which is a market here that we do a ton of business in, and kept buying stuff, adding value, refinancing, exchanging. And then along the way, I started helping our clients doing the same thing. So I would use my brokerage business to help me acquire more property and help our clients grow their own portfolios. Today, have I think 13 buildings now, about 110 units. So these are kind of small and medium-sized apartment buildings, and these are mostly in kind of transition zones that are redeveloping, that were maybe not as nice and are getting nicer rapidly, that are very close to nicer areas, but where people are moving into, which I think we're seeing in a lot of areas in the country right now, and have done a lot of value add deals in order to obviously make the numbers work out in cash flow, because we're in a low cap rate, high GRM market here.
Got it. Awesome. So I think first question that jumps out, Anthony, is how the heck you're making this work? You're buying buildings at sort of a 2.5, 3, 4 cap. They need work. Could you maybe share with our viewers how do you go about this? Like, what are the telltale signs you're looking for in your market?
So it's all about the market rents here. If you know what a unit can rent for, redone and upgraded, then you're going to know your stabilized cap rate or your stabilized gross rent multiplier, which is going to allow you to calculate your stabilized cash flow after you raise rents. So often we're buying buildings that have anywhere between a 20% to even, I've done buildings that have had 100% upside in rents that need to be repositioned, remodeled, units upgraded in order to cash flow. And so the numbers look awful often at purchase, like you mentioned, 2, 3, 4% cap rates. But we'll frequently see deals where the stabilized cap rate is at a 6% or even higher here in Los Angeles. And so that allows you to buy stuff with those rates. If you're at a 6 cap, stabilized, you can cash flow with 25% down on the initial purchase. So figuring out the financing, you have to obviously use bridge debt to get that done. You're not going to be able to do a conventional loan. It's not going to debt service unless you have a huge down payment to go in with it. But if you can get those relationships with either private or bridge debt lined up, buy the property, turn it around in the span of 6 to 12 months, and then either refinance later or sell, you're in really good shape. And then you've added a ton of value, and you now have a cash flowing asset on top of that.
I see. So regarding bridge debt, is that like an expensive hard money there, Anthony, with 12-14% with bunch of points, or is it like a true bridge debt that come along? Could you maybe share?
I've done both. So, I think there's quite a few bridge programs out there where the rates are, even in the sevens. You'll even maybe see stuff in the 6. It's interest only, so the payments are easier to do. Some of these lenders will give you a renovation budget and basically an account that you can draw from to do your renovation, so you don't have to fund it out of your own pocket. Some of them will even give you an interest reserve, so they'll make the mortgage payments for you during the stabilization period. That helps a lot. Those loans have pretty strict underwriting, appraisals, and they can be difficult to deal with even after close because there's a lot of stuff that goes on with fund control with those banks.
Sure, I've done a couple of those. Inspections, permits, there's just all of that.
Yeah. So, I've done a couple of those and haven't had great experiences with those. So what I tend to do is you can get pretty good deals on more informal bridge loans where the rate's a little higher. I think right now we're seeing 9% is a typical interest rate. That's still interest only. You'll pay about 1.5 points on something like that. So the terms are not too bad. That'd be for like a 12-month loan that's then extendable for another 12. And I've just found it makes my life a lot easier to go in with that. That allows me to compete really hard on the purchase because those loans don't need to do nearly as much underwriting. We have relationships with lenders. Well, they're basically look at our pro forma, our write-up on the property. If they agree with us and we have a good relationship, they're going to fund it and we can close in a couple weeks. So I do that more often than I do the more traditional bridge loans that you might hear about that have more strict underwriting standards.
Right. So it obviously sounds like a relationship-based prior positive experience goes a long way. And speaking of that sort of bridge, are these, like private individuals or, quasi 2 or 3 individuals with a company who are lending you money, knowing based on your prior relationship? Is it more of that nature, Anthony?
Out here, it's not. It's usually people that are running debt funds that go out and raise funds from other private individuals, family trusts, companies, and then they specialize in kind of placing those funds into different.
It's a yield play for them, basically.
Right, and then they make the arbitrage or the points on this deal. So there's these guys that do a lot of these loans out here, and it's not like you're necessarily getting the money from one individual, although sometimes you will. It depends how they structure each deal, but you're able to go back to the same, say, loan broker or the person managing each debt fund to get that done.
Right. So now, speaking of your deals, Anthony, right? As expensive those purchase prices are, right? So a novice investor coming in, trying to, gauge your market, I would say, the chances of failure are pretty high. And also, I would almost maybe preface this by saying that trying to be successful in your market requires a extreme precision and a lot of intelligence, that you gotta study exact rents, know exact, what those rents are block by block, and study that data before someone can make a decision that, hey, I'm just going to jump in and buy a 6-unit building in your market. Would that be a correct statement?
Yes, you definitely don't want to go in with your eyes closed on these things. You need to know your market rent so you can get yourself in big trouble. Luckily, you can work with people like us and we can help you do that because we do a lot of these things. But you got to know. On the other hand, although you have to know your numbers, it's a dense area out here. There are a lot of rental comps available, and it's fairly easy to do the research and figure out where you're going to be. So, and there's also a huge rental demand here. So it's not like you need to differentiate the end product that far from the next unit over. There's so much demand for our space here. Vacancy rates are so low that, renting the finished renovated units are pretty easy.
Good, very good point there. So speaking about market research, Anthony, I know when you go to, let's say, Zillow or these other public websites like Redfin and things like that, right? Sometimes the data can be flawed, right? So if I am a new investor coming into your market, or for example, a curious listener listening to this podcast, could you maybe give our listeners some sort of tips and tricks that you have used so far to gain intelligence on your market, and also maybe look for signs in your deals that, hey, if you see some of these numbers, these may be some of the show tell signs of possibility of a good deal in your market. Could you maybe speak to some of that?
So I think, first of all, if you want to do this in any market, you've got to have a strong relationship with a great property manager. They're going to be a way better source of real market rent information than poking around on Zillow or Redfin or anything like that. If they're managing a bunch of units in the area that you're looking to invest, they should be coming along with you when you're doing walkthroughs or inspections and you're looking at getting buildings in contract. We bring them with on everything that we do, and they help us calibrate and double check on what we think the market rents might be, because they're going to have to manage the units. So I think that's number one for getting a sense of market rents. As far as easier to access rent data, my favorite website is Rentometer, because it helps aggregate rents, asking rents from lots of different platforms. In our market, at least, I've found that to be a very accurate website. You have to watch it a little bit, because it'll sometimes, if you're in a market with not a lot of rent comp data, it'll pull things from way too wide of a radius and it won't be very accurate. But in our market, there's so many rentals that in a few block radius, you can get really quality data from that website. So that's probably my favorite source there.
Very good point.
As far as looking at buildings and identifying whether it's going to be a good deal or not, have those conversations early with your manager. Take a look at the rent comps on sites like that. And when you see listings, double check the square footage of the unit. It's really easy to see, a one bedroom. Oh, market rent here is $1,400. I'm sure of it because it's a one bedroom. But if it's a 500 square foot one bedroom versus a 750 square foot one bedroom, that's a different story. So do the math on how many square footage is in, how much square footage is in each unit. That's going to help you figure out your market rents. And then from there, try and get a sense of the narrative and the story behind the building. Is it owner managed? Have they owned it for a really long time? Is it an out of area owner? Is there an opportunity there or maybe is there a reason that rents would be under market? And that's going to help tell you the story and give you a good idea of whether you're actually looking at a good deal.
I see. And do you track data like, on a monthly basis, quarterly basis in general as to, what may have sold around there to kind of gain a pulse of your market? Does your group does any of that, Anthony, by the way?
Absolutely. Yeah. We actually do our own market research in our area because we find the existing market research that you can go out and buy there in general is kind of on too large of a scale. It's available for large submarkets and metro areas, but we really want granular, detailed market data. So we have our analysis and research team go through every single quarter and look at every closed sale, and we have them correct any errors and what we think might be, overstatements of the rents. And we publish our own market studies every quarter. So that allows us to track data year by year, quarter by quarter, keep track of trends. We do local meetings with investors where we'll present that data and go over what's happened in the last quarter, what we expect to be coming. And that gives us a great advantage over everybody else out here in looking at some of these deals. We also do that for 2 to 4 unit properties here, which is a really underserved market from the rest of the research platforms out there. I'm not sure you can get that kind of data anywhere else on 2 to 4 unit properties. So it's a huge advantage for us. Yeah.
Awesome. And I think one of the beautiful things also is that you have your own brokerage. So with this niche, I'm sure you're able to, provide so much value to your clients, because as you said, some of this data is just not out there publicly. And since your
Right.
team is tracking this, I think it's a great, it's a great point to have this data handy and, present it to your clients. Very handy to have. Um, Also, speaking of these different buildings, Anthony, here, like where I invest personally in Baltimore, we have very different historic neighborhoods, and
Yeah.
how you analyze these buildings and the characteristics, whether it's exterior or interior features and things like that, determine and go a long way how these buildings are valued. Is it similar in your market as well?
We definitely have that going on. I do a lot of business in Long Beach, as I mentioned,
Mhm.
and Long Beach is a really old city. It's one of the older cities in Southern California. Most of it was built in the 1920s, which is great because a lot of the buildings have a ton of character, and that's really popular with the market there and with the renters. They love, living in these restored older buildings that look a lot more interesting than your average 1960s box that you might see in the rest of LA. But
Right.
for sure, there's a lot of historic districts in Long Beach. And in the historic districts, we're fortunate in that they really only control what you can do to the exterior of the building. It's not quite so stringent as it is on a true historically designated property. That's a very different thing where then the city really wants to be involved with you on specific changes that you make.
Right,
But the
right.
majority of
And
the buildings, they're just in a historic district. They just want you to maintain a consistent style with the way the building was built. So they want to improve your colors and your materials on the outside, but you're pretty much free to do whatever you want on the inside. So it keeps a really nice, consistent feel to the area. As long as you work with the city, it's pretty easy to get approval. They'll kind of just tell you, well, you can do this or this. You choose, and but you can do what you want on the inside. So then it's pretty nice.
absolutely, absolutely. And just a tip for our listeners here, Anthony, what you said is very true. And that happens here in Baltimore City as well, where we are investing in extremely close, tight knit, whether it's central business district, and the characteristics are exactly similar. Buildings built in, like, let's say, early 1800s or mid, 1900s and things like that. And stone front, they'll probably have pebble stone walkways in the front and things like that. Probably 20 feet ceilings sometimes, like really tall ceilings. And there's so much character to these buildings, and the way they are valued, their pricing model is different. It's just not based on square footage. Some of these buildings, as you rightfully pointed out, Anthony, is that they could be looking great vintage on the exterior, but as you
Right.
go in, it's a fully modern building with granite and, like central AC and things like that, which I think brings me to the next topic here, Anthony, is how you're identifying these buildings, that what different value add components you're doing, whether it's
Mhm.
utilities or renovating kitchens and flooring,
Right.
or maybe doing different styles of paintings and things like that. Could you maybe elaborate your
Sure.
philosophy as to how you go about this?
Yeah, so I mean, you want to spend your money on improvements that are going to get you more rent, obviously.
Sure.
So for the exterior, we do. Ideally, you can find a building that already has some nice curb appeal that just needs to be cleaned up a little bit. So paint and landscaping goes a long way, and that's some of the cheapest things you can do on the outside of the building. We almost always do that when we buy a new one. If there's an opportunity to change out siding or do a little with exterior lighting, I'll add a few touches there. That tends to modernize things a lot. You'd be surprised how much even the lettering or the numbers on the address makes a difference, which is a really cheap thing to do to kind of refresh it and make it stand out on the street. And then beyond that, sometimes I will do windows. I really like windows as one of the best improvements you can do because it improves the curb appeal on the outside and it also improves the feel on the inside of the units. It's one of
Sure.
the only
So
improvements.
on Windows, there, Anthony, what
Mhm.
exactly are you doing? Are you painting the trims, or are you doing any specific colors, or like making them
Yeah,
maybe like sometimes you have those dark color ones. Are you doing
right.
some of that?
So we're usually just doing new white vinyl windows. that are really cheap and easy to get in. They're easy to do on a lot of buildings. They don't allow you to do that in the historical districts, though. You can't have white vinyl. You have to have the original wood or whatever else matches historically. So then you're really doing more restoration, and then we're bringing in companies that will usually restore, fill, and replace the existing wood windows, which can be more expensive. So I'll tend to do the windows in the buildings that aren't historically designated. And then around the white, I like to do a nice gray. The contrast of the gray and white, I think, is a great modern look. Goes well with a lot of different styles of architecture, and it makes the building pop.
Right. And so when you're looking at these deals, Anthony, what sort of rent spread you're looking for to make the numbers work? Because it sounds like your strategy is to, value add, improve the rents, and perhaps hold it for the long term. Would that be a correct characterization?
Yeah, that's accurate.
Gotcha. So how what sort of rent spreads you're looking for? Because it sounds like, if you're just buying the building based on, let's say on market rent, and you do the, improvement, that's going to make you pretty much a high price landlord, right? So that probably will lead to, not having your buildings rented, quickly. So you want to be, as I call it, have a great product at the right price and, keep them consistently occupied. So in other words, so when you're purchasing your buildings, you got to purchase them at a good price. So, and, obviously look for those rent bumps along the way. Could you maybe elaborate how you analyze that and how your philosophy is around it?
So first of all, we have quite a few Class A builders in the area building much larger buildings and catering to a totally different type of renter.
Sure.
And I try not to get into that space and compete with those buildings. And those are brand new construction, high rises, stuff like that. They're getting, $2,500 for a 1-bedroom unit.
Wow.
I'm more in the middle area there where I'm going to buy an older building. I'm going to turn it around a bit. I'm going to do a nice job on the inside, but I'm not going to spend a fortune. I'll probably spend anywhere between $10,000 and $15,000 on the interior of a unit to renovate it.
Mm-hmm.
And, the same 1-bedroom apartment might go for $1,400, $1,500, where it was maybe at $1,000 previously. For me, the buildings tend to have an upside of at least 20% off existing rents, but it's less about what the upside is on actual rents than it is about the market gross rent multiplier or the market cap rate that I'm going to buy a building at. So that's really more what I'm looking at. If there's not very much upside in the rents, but I don't have to do a lot of work and I get a great deal on the building and the market cap rate's a 6, that's one way to do it, and that's fine. Or if the rents need to be raised by 50% and I pay a terrible cap rate on actual rents, but I can get it there and it gets to 6 in the end, it's actually the same result for me. So, I'm not necessarily concerned only with the upside in rents. It's more about that stabilized scenario. And I do try and get buildings that are going to end up at least around a 6 cap, or around 10, 11 times gross on the gross rent multiplier. Once I get rents to market, that's really what I'm looking for.
Sure. So for a novice listener, you said a few terms that I think we should clarify and that are somehow unique to this space where, you're buying buildings or, high price building. This is not a sprawling 200 unit complex. This is, more dense area, and the whole mechanics around how you buy them, how you sort of zone in on them is extremely unique. It's just a culture, or as I call it, it's a beast of its own. Could you maybe share some these the terms that you said, gross rent multiplier? What exactly is that, or its correlation to what your market value of your building is going to be?
Sure. So the easiest way to think about the gross rent multiplier is it is the dollars you pay in purchase price for every $1 in annual rental revenue. The math on it would just be the price or the value of the building divided by the gross scheduled rents, which would be the total of your rent roll times 12. And the interesting thing about the gross rent multiplier is it's a really simple metric. It completely ignores expenses, it ignores financing, it ignores vacancy. So it's an academic number, of course, because every building is going to have expenses, financing, all that kind of stuff. But it's great because it's the purest possible representation you can get between the dollars that you're paying for the rent, which makes it really easy for me to do the analysis on these buildings basically in my head or back of the envelope or whatever. I know that, at 12 times gross, a building's going to cash flow with 25% down. Really 13 times gross or below, that's going to work, just because I know how the expenses tend to work in our market. And it's really easy to see listings that have understated expenses that might, skew the cap rate. By the same ticket, if you know that the gross rent multiplier is a representation of what you're paying in purchase price for every $1 in annual rent, it's also the value you create by raising the rent by $1. Sure. So if our local GRM is around 15, for every dollar you can raise the rent, you make $15 in value, which is a huge benefit for investing in a more expensive area like Southern California.
Awesome. So there are a couple of questions that I think we should again clarify within that conversation. The expenses that you said, right? The gross rent multiplier I want to highlight for our viewers is a sort of a thumb rule or just a starting point. The expenses in these buildings can vary, whether, which type of heating system you have, what sort of cooling does it have. So it's almost, I call it as I said, just a preliminary starting point that whether you are in a shooting range or not. But then you have to sort of normalize these deals based on, oh gosh, it's so dated, or probably the heating system will need replacement and things like that. Could you maybe share some words of experiences that once you have this deal that looks decent within a sort of a GRM bracket, if I may call it, right? If it looks something similar within your GRM range, could you maybe share like what steps you take or what other factors, and specifically I'm saying like expenses are like a big one that can skew a deal, right? Could you maybe talk about some of that, Anthony?
Sure. So we're really fortunate here in SoCal. We have great weather, right? So a lot of the expenses and the variability that I think you'd see in other parts of the country. Sure. Like I'm originally from Minneapolis, so there's lots to think about, like heating and stuff like that, and the winter and the maintenance and all that kind of stuff. Here in California, especially in the coastal markets where we do a lot of business, it's rare that any building would ever have air conditioning. It's rare that any of the buildings we work in even have central heating or forced air heating. The vast majority of the buildings we do have got one gas wall heater, and that's it in the living room, and that's kind of our market. So that makes life a lot easier to begin with for us.
I tell you, Anthony, your life is simple. I can tell you that.
Really easy. But a lot of things that we'll identify on the expense side right off the bat is how much landscaping is there, because the water bill can be big. Here we don't get a lot of rain. So if the building has a lot of landscaping, you're going to have a lot more utility expense there for keeping up the building. We have some old buildings here as well that are master metered for electrical and gas. So that's a huge one. You can't really compare, it's not apples to apples on a separately metered building for electric and gas versus a master metered building, especially for electric, you see that. And then, your utility bills are going to be way higher. Those are probably the two biggest easy ways to identify buildings that are going to have higher expense ratios. After that, you want to look for amenities, right? So if you've got elevator service, that's a big one. If you're 16 units and above, you need a resident manager. If you have a guard or you have staff on site, that's a huge expense. Most buildings have a laundry room, but that's pretty minor. It's really when you start getting into some of these, amenities and bigger grounds and stuff like that things start to get a lot more expensive.
I see. So now, speaking of those master meters and things like that, so if someone is to purchase such a building, right, do you advise them to maybe build back, do like a RUBS program, as we call it? Do you do some of that, Anthony, or is landlord absorbing, all the utility bills? How's your strategy around that?
You can do it kind of one of four ways is where I see it a lot here. You can go solar, which has not actually been a great solution for us here. It hasn't penciled out that well on the buildings that I've seen. And then usually in most cases, you have a lease that then is encumbered on the property, and that becomes a problem. Sure. You can do it like a RUBS system and backbill the tenants. We see that occasionally here, but it's not as common as it is in some other markets, I understand. So tenants can be a little put off by that. And by dividing it by the square footage, you can't necessarily say who's using more and who's using less. So it's not the fairest way to do it, although you do see that happen. You can also just charge more in rent and absorb it and say utilities are included. That's probably the most common thing that I see. And then it's actually not that expensive to separately meter a property if it's master metered right now. You work with the city, work with an electrician, and build the meters. It's going to drastically lower your cap rate by eliminating expenses and then fairly passing on the tenants' expenses based on their own actual usage. That's probably the best way to do it, but that's also one of the more expensive ways to do it.
Right. So what sort of expense ratio you typically run these buildings at, Anthony? And the reason I ask is that obviously when someone is analyzing these buildings and you want to spot some inaccuracies, maybe that may be thrown off by sellers, what is sort of your on-the-field experience about your expense ratios?
A great easy rule of thumb that I found to be accurate in many cases here is about a 35% expense ratio.
Got it.
And I know that's lower than a lot of other areas in the country.
Sure.
And I think that's for two reasons. One, expenses here are lower in general because of, like I said, the weather and the simplicity to our buildings. The other reason is that the cost of some of these services and expenses are not a whole lot more than they are in other markets here, but relative to the rent that you bring in, it's so much lower on a percentage basis because our rents are so ridiculously high. So you do actually see a lower expense ratio here than you do in a lot of markets.
Right. And there's a reason for it. I think as you described, the heating components or the cooling central AC and things like that, you don't have that. So that does tend to be a large share of expense in in most of the like Eastern Seaboard or like Southeast markets and things like that. So that's a major difference right there. So I want to shift the discussion to the valuation that I think we were saying just a few moments earlier, Anthony, right? So you said you do the value add and things like that, and you have sort of a factor by which your building value increases. Could you maybe elaborate as to how you go about it and how it works in your market, Anthony?
Yeah, I mean, buildings really are appraised and resold here on cap rate and GRM. So, that's what I love about apartment buildings in general. If you know your market and you know what, the market GRM is, you're going to be able to know your exit value either on a resale or on a refi. So if I know, for example, going in, like the GRM is probably the easiest way to do this calculation. If I know I'm in an area that is a 15 times gross area, for every dollar I raise the rent, I make $15. So if I can raise the rent by $100, I make quite a bit of money. I make $1,500. That's only per month. If I can raise it by $1,000 a year, I make $15,000. And so frequently we'll go in and see properties where your units are $200 or $300 dollars per month under market. And by increasing the rents by $200 or $300 per unit, which is actually not that much here, you're adding $50,000 in value per unit or thereabouts when you're redoing the units, and that tends to cost you anywhere between 10 and 15 grand. So the numbers actually work out really well for value add deals here as far as increasing your equity position goes.
That's awesome. It's a strong market, and I think your ability to charge sort of premium rents for a renovated building is a lot higher. And I'm sure there is a sort of a market cycle to it that perhaps in certain months the rentals probably are short. So whatever is the inventory, that's probably a tad pricier. Which story is true here in my side of the neck of woods here is that there are certain months where the demand is so high that we are charging more rents, whether it's $75 to $125, we are charging more. Do you see that dynamic in your market as well, Anthony?
I think it's there for sure. It's a lot easier to rent units in the spring and summer. That's when people are looking to move. And it's especially quiet in December and January when people are dealing with the holidays and the turn of the year.
Sure.
Luckily we don't have snow to deal with, so people are still willing to move during that time. But yeah, when I've had vacancies over the holidays, they've sometimes sat on the market and it's taken much longer. Whereas this time of year, it's late March right now. This is perfect. So this is a great time to be renovating units and getting them back out. I'd say they're easier to rent in the spring and summer, although I wouldn't necessarily say we get a huge premium on the dollar amount. They
I
just
see.
go faster.
I see. So speaking of value add, what specific things you are doing in your apartment? Like I know you said you're spending somewhere closer to between 10 to 15,000 a unit.
Right.
What specific things you are addressing in these buildings?
So we're usually doing vinyl plank floors throughout the whole unit, which are great. They're impervious to water, so they're really durable. They last for multiple tenancies, and they're not that expensive. That makes a huge difference on especially some of these smaller units, because the unit's going to feel a lot larger without carpet, with the hard flooring in it.
Sure.
So we always do that. Of course, paint, do a two-tone paint. I like to do a nice gray with white trim and accents in a lot of our units. We are redoing kitchens, and about half the time we'll pull the cabinets out entirely and do the prefabricated cabinets, but still nice, the European style hinges, and then a quartz countertop on top with an undermount sink. And then you can get nice plumbing fixtures that look like the high-end stuff, some of those kind of gooseneck sinks that look really cool. Maybe an interesting backsplash, some glass tile or something like that that's been popular recently. In bathrooms, if we can do it, we'll reglaze an old tub. We'll usually pull out a plastic or fiberglass shower enclosure if it's in the budget, and we'll do a tile surround with a little niche. That just really updates things and looks way nicer in the bathroom. Some of these old units come with clawfoot tubs, actually, that have been tiled over. So when we have the opportunity there, or if there's hardwood floors under carpets, we're going to restore that instead. We're going to pull up the carpet, refinish the hardwood floors. We're going to take the tile off of the clawfoot tub, try and restore and reglaze that tub and put that back in. The rental market here really likes that sort of.
Oh, there's so much demand for those clawfoot tubs, and just the appeal of that entire dynamic. A lot of young professionals moving in and things like that.
Love
The
that
whole
stuff.
retro look, as I call it, it's such a crowd puller.
Yep.
Awesome.
Yep.
And like what sort of pricing you're paying on these, like an average kitchen or a bathroom if you're tiling, what sort of dollar spend you're doing just on the kitchen? Or
it's not bad. I think to do a kitchen like that's probably $4,000 or $5,000 depending on the size. The bathroom probably 3 to 4. And then the balance of the budget is going to go into flooring and paint. So, we can do a whole unit like that. Like I said, between $10,000 to $15,000. I pretty much don't care what condition the unit's in when I see it, because whether it's just out of date and clean or whether it's totally beat up and needs to be done, it's kind of the same price. It's going to be right about in that range every time.
Right. And actually, sometimes in these scenarios, the more beat up the unit, I think you have that ability or you get leverage to negotiate further, because like whether it's 20% bad or 50% bad, you want the 50% bad so that you can buy it cheaper, right?
Exactly. Yeah, exactly.
Right. And speaking of these units here, right? Anthony, what is your management strategy? Like basically, I know in a sprawling complex, you can have, on-site managers and things like that. So are you using local property managers, or does your group, I know many brokerages have property management arm of their own as well. How do you go about managing your properties?
We do not do our own management. We have a close strategic partnership with a local management company that manages around 2,000 units in the area. And they manage all the buildings I own, and they manage the vast majority of the buildings that our tenants buy as well. I think that's such a specialized business, and it's so difficult that to do it ourselves, it would really distract us from the brokerage business and finding the deals and helping our clients get into stuff. So I always use a professional manager on my buildings. That tends to cost 6 or 7% for the size buildings that we're doing, and that's a totally full service management company. They pay all the bills, they do the accounting, I change my address for everything to their office. My tenants don't interface with me at all, and in fact they even quarterback all of the work for me too. So I'm not out there buying materials or even dealing with any of the renovations. They do it for me. So they're an incredibly valuable partner to be able to. I wouldn't be able to do this without them at all.
Absolutely. So You're basically saying, obviously, the property management side is handled by them, but at
Yep.
the same time, the renovations are also handled by them. Is
They
that correct?
do. Yeah, their supervisors do a great job, and they know what needs to be done to the building to get to market rent. So, what
Sure.
better person to handle the renovations than the person that's going to be renting the unit
Oh,
out, right?
absolutely. They
Yeah.
know it better. They know the pulse of the market. They know what's hot, what's selling,
Yep.
and boom, you have it in your units. So, is there a construction premium they charge? Like I know some property management companies charge for such renovations.
It's case by case. I think if it's a unit here or a unit there, or keeping the building going, they may not charge.
Mhm.
If it's a big job and they're going to do everything, yeah, then they're going to charge. I think they're usually going to charge about 8% of the job,
Mhm.
which is still cheaper than say hiring a general contractor. And
Mhm.
they have great teams of workers and subcontractors that can do this at it for a really reasonable price. So I think it's very fair. We end up paying a lot less than we would if we went and hired a general contractor to do this stuff.
Gotcha. This is a unique position and a unique style of investing, Anthony, which I think is probably doesn't get brought up in many of the shows. And I think
Yeah,
we're highlighting this that for a lot of our investors who may be, quite frankly, in your markets or markets like Washington D.C., which is right in your
sure.
backyard here, probably New York downtown and things like that. It's a very viable strategy. The art of buying these properties at a tad below and doing your value add and raising the rents to the market is an extremely successful one actually. And I appreciate your advice, Anthony, today. Please share with our listeners how they can find you and sort of what things you're looking forward to now.
Absolutely. Feel free to reach out to us. Our website is buckinghaminvestments.com. That's all spelled out in plural. And you can reach me at anthony.walker@buckinghaminvestments.com. That's my email. We'd love to hear from any listeners, and we'd love to help people out do the same thing that we're doing.
That is wonderful. That wonderful. Thank you, Anthony. I appreciate all your advice today. It's been a pleasure having you, and I look forward to chatting more as you do more deals.
Absolutely. Thanks for having me on.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.